Hey guys, it's Michael and Ewan from Modano again. We are here to walk you through the annual forecast model training course. This is a fundamentally important training course. We've given it over 20 years to thousands of companies. Originally back in the day, Goldman's analyst training program, KPMG's corporate finance team, back when we did it all manually. So this course used to take an entire day with people fidgeting around writing formulas. Because we now have modules and modular development and automation, we can do the whole thing in 1 to 2 hours. So we should be able to whiz through this. Again, there is a PDF document that explains all the concepts in this course. It's actually quite a theoretical course because it explains how all the pieces of a financial model fit together. It's a simple forecast model, but the concepts are so fundamental that they apply to anything from, a project finance model to a startup model. So we are going to work through building up a model from scratch, inserting one module at a time and explaining the financial statement impacts of each and how the final financial model comes together. So let's dive in. To start with, let's look at just the scope of this model. You can see we're going to do it based on a basic model, a forecast-only model of a company called Wall Street Promotions. So Wall Street Promotions is a hypothetical company we've made up that provides promotional events on Wall Street for investment banks, etc. It's going to be a very simple model. It's going to use what we call our chart of accounts 1, which basically means it doesn't have inventory or cost of goods sold. It's basically an events-based business, and we're not going to model out anything in too much detail, but it's going to have all the fundamental things like revenues, expenses, working capital, fixed assets with depreciation, debt, equity, full integrated for 3 ways. But because it's only forecast only, we're not going to worry about things like rolling, which is covered in the next training course, the historical and forecast model training course. So we're going to build an annual forecast 5-year model of this hypothetical Wall Street Promotions business, starting on the 1st of January 2019 and based in the United States. Okay, so before we jump in, let's just have a look at this diagram. Now this diagram is the key to understanding the fundamental foundation of an integrated modular financial model. So this is a simplification of reality, but it shows you the modules we're going to put in today to build a basic model. Because it's forecast only, we're starting with an opening balance sheet. That then provides opening balances to all the modules that contain balance sheet data, obviously debtors, creditors, fixed assets, debt, equity, corporate tax, and other balance sheet items. And then we have revenues and expenses, other revenues and expenses flowing through into the financial statements and debtors and creditors. And we have capital expenditure flowing into fixed assets, which goes into all 3 financials. So this is a really great diagram to conceptualize what a modular financial model looks like. And that's how the best financial modelers think, even when they're doing things from scratch. We get told this all the time by people that start using modules. They're like, "Oh, this is how I've always built." It just makes it much clearer. So that's the mentality we want you to start thinking in when you're starting to build even really complex models. Is how do you break them down into pieces that but for links between them are largely interchangeable, and that is the whole concept of modular financial modeling. Okay, so let's get started. So to get started, let's open the assumptions file for this exercise. Cool. The assumptions file is quite simple. It's got 2 sheets. You can download it from the training section of your account where all these materials are. The first sheet is the opening balance sheet as at the end of December 18, so that basically the 1st of January 19. The opening balance sheet contains all the data we need to basically get the model up and running. The second sheet contains all the forecasts. You see, because it's a relatively simple model, but it's to be honest, it's what you'd see in 99.9% of financial models. So we have just revenues, operating expenditures, other revenues, and it works the whole way down, which we're going to do today. So there's going to be a little bit of assumption entry in this process, but we're going to talk through what we're doing as we do it, so it's not going to be too painful. Okay, so let's get started. The first area we're going to start with is actually also the last area, which is basically the financial statements. So in an integrated financial model, everything revolves around the financial statements, but one of the big things people miss is that the financial statements themselves aren't the model. So you'll see a really badly built model will contain a whole lot of calculations, like tax expense will be calculated in the income statement. Whereas a really high quality model will have tax analysis done in another part of the model, and the outputs of that will flow into the financial statements. So if I just show you on my screen, we're going to work through building with the opening balance sheet and the financial statements, link those together, and then we're going to basically pull all the pieces in that flow into those revenues and expenses, debtors and creditors, otherwise known as working capital, capital expenditure feeding in fixed assets, and then capital, which is debt and ordinary equity. We're just keeping it simple, no mezz debt, prefs, etc. And then we have corporate taxation to give us our tax expense and tax paid, and then other financial statement items, which is where you just have things on your balance sheet like other or provisions. which we're not going to model in any complexity, but we're still going to include them so we can reconcile our financials. Now, in terms of the financial statements, the most important thing to bear in mind when you build a financial model is that primarily the links between the financial statements should be net profit. I remember when I did this training in New York, you've got basically net profit, you've got earnings that swim down into retained profits, and you've got cash from the cash flow statement that swims up into cash at bank. And other than those relationships, which you can see in this financial statement impacts diagram, your financial statements should have data coming in from all the pieces of analysis in the model, not from other financial statements. So bad practice is where you model something in the income statement, for example, revenue drivers in the income statement, and then you link your cash flow statement to the revenue in the income statement. That's all bad. That's not modular. It's not best practice. It's just all bad. And we see that everywhere. So instead, what we're going to do today is we're going to show you how you start with financials that are integrated, and then you add things to the financials as you build it up on a driver-specific basis. Now, these diagrams are called financial statement impact diagrams. They're very, very handy for showing standalone impacts of things. Now, obviously, in real life, you wouldn't have a business with just revenue, right?
Wouldn't have thought so.
Yeah, but this is the financial modeling equivalent of debits and credits. We find these really handy when you're doing really complex things, like when you're trying to look at the impacts of something like a convertible preference share, and you're looking at how is that going to flow through and balance. Instead of looking at debits and credits, you look at how it will impact the three different financial statements and how the flow of retained profit, earnings, net profit after tax down into earnings, and your change in cash into your cash at bank will result in the balance sheet always balancing. And obviously is your one true source of truth is the balance sheet balances if you know what you're doing. Now, this diagram I'm showing on screen now is basically indicative of what happens when you grab a whole lot of different pieces. And we've used colors to highlight, light blue, operational, green, working capital, purple, assets, capital is orange, and then we basically have some other pieces like other, which are in grey. But what this tries to show you is that even the most complex set of financial statements in the world are actually just a mixture of really defined little pieces. And if you think about it that way, it should never get overwhelming. It should never get complicated, even in the most complex model you ever build. Okay, so let's get started. The first module we're going to put in is the opening balance sheet. So let's just open a new Excel workbook. And this is funny, because this is where in the old days, you'd open up an empty Excel file and you'd just start typing in headings for about 5 hours.
Yep.
Or you'd start typing in formulas going equals what? We're going to jump through that by just pumping modules in.
Okay.
If you want to understand how all the formulas work, they're all there. You can just dig in and walk through them, which is how most people learn, ultimately.
Cool.
So for the opening balance sheet, let's just open a new empty Excel file. So I think you've done that already. And just do insert from web. Okay, and we're going to insert from web. Now in this case, as we said, we're going to do chart of accounts 1. We're going to do separate assumptions and outputs for this. That's just a personal choice. More and more, we are building with single component analysis. In investment banking, we did a lot of, and project finance, you do a lot of separate assumptions and outputs because your assumptions are like a data book, and the outputs are all the calculations. It's a personal preference. It's, we're not here to debate that. We're going to do separate assumptions and outputs because this course has been this way for 5-10 years. So we're going to choose generic financial model, chart of accounts 1, separate assumptions and outputs, United States, and you need to change to annual time series. And just choose the opening balance sheet. So just start typing, type opening, and you'll see it down there. So usually opening balance sheet, chart of accounts 1, just make sure we've got all of that right. And then just press insert. Okay, so that's what this is going to do. Have you just come from the automation courses?
Yep.
You would have seen how when you insert a module like we did in the automation fundamentals, it puts in your table of contents and your error checks and gives you that surrounding infrastructure with everything's formatted and styled according to your options. So we're not going to cover that in this course. If you want to understand what's just happened there, you really need to go back to the standardization, review, and automation courses because they cover how that's all created. And if you want that to look purple, orange, and green, you can do that. That's not the focus of this course. Okay, so you'll see now we have an overview sheet, an assumption section, an output section. We have an output section. So at the moment, we just have an opening balance sheet. So we have an assumption section, and then we have a time series assumption section, the opening balance sheet, and then the appendices with the lookups and the checks. So let's just go to the cover sheet just to get this model up and running. Let's go to the cover sheet and just type in Wall Street Promotions as the entity name. And let's put annual forecast model as the model name. And let's just put as a note annual forecast only model of Wall Street Promotions. And we'll delete. And we'll delete and we'll delete the other two notes. Wall Street Promotions.
Try and keep up with you.
And then what I'm just going to quickly jump to here is on my screen is the diagram that shows how this is going to work. So with an opening balance sheet in a forecast only model, that obviously has all your starting data, which is like your starting line. And then your forecasts obviously feeding off that to the extent that you have balance sheet items. They all then feed into the integrated three-way models, but then your opening balance sheet also feeds into the all periods balance sheet, basically to give it its opening cash and retained profits balances.
Yeah, right.
And this diagram is a simplistic version of the prior diagram that just shows you the flows. A forecast only model is a lot easier because it's all forward. It's all forward. You don't have this rolling mechanism where you've got to worry about mapping all this data. You just have to map a few accounts, which we'll discuss today. Okay, so let's go to the time series assumptions. Just make sure for the time series assumptions we've got the financial year ends December. The first financial year is 2019. It's all too easy. Term 5 years, and let's put thousands as the denomination.
Can do.
Done.
Easy.
Okay, so let's go to our opening balance sheet. Now, the interesting thing about this is we're not going to put all the numbers in yet. If we put all the numbers in, what's going to happen is we're going to start building pieces, and the main balance sheet's going to constantly disbalance because the retained profits figure is going to be determined by all the numbers that go in, and it's not going to reconcile. So what we're going to do is we're going to put the assumptions in as we build this model today and put them in as we build each piece. So you can see where the numbers go in, where they impact the financials. Mm-hmm. This is, I should note, never how you build a financial model. Now, you would normally use a dynamic template that would be pre-built with 30 or 40 modules in it. And you'd basically, and that's what we'll do, I think, in the next exercise in the historical forecast model. We're building from scratch today, in as much as you ever would with modules, to demonstrate how you'd build this up. But bear in mind that you would never do it this way in reality. You'd build it using a new dynamic template, which is on the Modano tab, new menu. You do that, which we will do in future courses. Okay, so let's go into the opening balance sheet and just enter the cash assumption. Now, with this, there's going to be a lot of cutting and pasting, or copying and pasting. It's probably the easiest way to go. Go to the opening balance sheet, grab that cash balance of 1217.2 and paste that in. That's in. Now, there are lots of ways you can do this. Our opening balance sheet module we're using here, which is the most common way, is that we just automatically balance through retained profits. So you can't, if you scroll down to retained profits, we've now got cash is our assets. We have no liabilities, so our net assets are equal to cash, and our equity is equal to cash. That basically, that approach assumes that no matter what rubbish you bring into your financials, you're still a superhero that's got a balanced balance sheet. That's the way I've always seen it done in my career. You could go hardcore and actually make sure it balances with an error check, but that's how we've done it in here. Okay, so we're now going to put in the actual balance sheet. So that's the opening balance sheet. We're going to put in the forecast balance sheet, which we're just going to refer to as the balance sheet. So let's do insert from web. You'll see because we chose the library before, it's not going to show the library anymore. So we're just going to do balance sheet, chart of accounts 1. Let's insert that. And this will link in, as we said that diagram before, this will link in your opening cash balance, and it will link in your opening retained profits balance, which you can see there. So what we have now is an empty balance sheet with, and if you open up cash and open up retained profits, you can see we have literally opening balance coming through. We have no change in cash because we have no cash flow statement. We have no net profit after tax coming through because we have no income statement. So we just have cash sitting there. Mm-hmm. It's a dormant company. It's an SPAC. It's an SPAC with nothing to acquire. Very topical. So it just needs to start paying dividends, and it'll be the best company ever. Okay, so we basically now have now let's just go to our build tab and have a look at the link. Actually, sorry, go to the links. Just go to links, module links, and click on that top button under module links, and let's just look at the links of that module. So you can see there if you actually show links, show module links. All we've got there is our opening balance sheet linking in cash closing balance and retained profits closing balance into the balance sheet. Yep. That's all we're at right now, and everything's empty. So now let's put in our income statement. So let's do insert from web.
Same as before?
Same as before. It's all pretty straightforward, this stuff. The financial statements are quite easy to set up, these guys. So income statement, there's only one, chart of accounts 1 in that particular library. And this is going to go in. It's going to go in above the balance sheet because that's the way we ordered the modules when we created the library. And you'll see that it's got nothing in it. Mm-hmm. Without historical data, the income statement is just inserted. It's got no precedence because there's no historical revenues and expenses that it has to map to. So it's pretty simple stuff. Although we do need to obviously populate that next. So at the moment, if you open up revenue, there's just nothing there. There's just zeros and empty categories. It's basically an empty template. If you go down to net profit after tax, it's obviously calculated that. And you'll see that that's now gone into, if you go down to the net profit after tax, the retained profits, you'll see that that's now linking in. So if you just do Alt-TUT, there it is there. That's it. That's what you need to do. You can see that's flowing through. So that's linking in. There's just no data, so we can't really see anything yet. And if we go up to our income statement, just click in your income statement now, and just click on the links again, just the build tab, module links, and you can see that link in show links. A link is going into the balance sheet, and if you click on the balance sheet links, that's now linking in the opening cash and retained profits from the opening balance sheet and net profit after tax from the income statement. They're just simple formulas. In the old days, we'd spend half an hour writing those formulas to demonstrate this. You can just check them out. That's how it always works. Okay, so now let's do the same with the cash flow statement.
Cool. Insert that from web. Same again.
I've got an interesting question for you.
Okay.
Why does a cash flow statement exist?
I'm on the spot here.
That's what someone asked me years ago, is why does a cash flow statement exist? Why isn't the income statement the same as the cash flow statement? And then he basically started talking to me about matching, okay? So matching is the concept, obviously matching your revenues and expenses in your income statement to when they're actually accrued, or when they're earned, or whether they're incurred. So it's interesting with something like depreciation, for example. If you just put your depreciation straight through if you put your capex straight through as an operating expense, you'd have horrible earnings every year where you bought a new machine, and every other year you'd overstate your earnings. So it's really interesting stuff. And this is where, when you're modelling it up this way, when you're modelling just cash, your income statement's going to stay the same as your cash flow statement until you have differences between the recognition of revenues and expenses and the cash payments and receipts. So it's interesting stuff. So let's go for the cash flow statement. You'll see the cash flow statement now has come in. It's again got complete zeros. There's nothing in there. And the net change in cash held, which is the ultimate outcome of that. It's a direct cash flow statement we've used here. Some people love indirect cash flow statements. We often put them in as a presentation output. It's really up to you. The direct cash flow statement is much clearer, we think, for modelling purposes. But again, it's just a presentation thing. So, there's nothing to stop you either rearranging this or actually adding it. We normally add it as a secondary layout. But this is a direct cash flow statement. And if you just go to the cash flow statement providers we'll discuss later, let's just go to our change in cash on the balance sheet and just check that that's linked in. Yep. So that's linked in there. And if you just do Alt LUR on that, this is where the Traverse formula tool is great for sort of understanding how this works. There's the flows. Now, if you go into your balance sheet now, and just click trace precedence of the links.
On the links again. Yep.
You can see now we have all three of those linking in, and you can see we're linking in changing cash at bank from the cash flow statement. Okay, so we now have this great infrastructure. We have no data yet in our opening balance sheet other than cash, but we've got the infrastructure in there. So now we're going to start plowing in and putting in basically the data. So the first thing we're going to start with in a financial model like this is revenue. And obviously, it wouldn't matter if we were spending 3 months forecasting revenue based on some obscenely complex drivers. The flows through the financial statements are mostly the same most of the time. I say that putting aside some complexities with things like SaaS has deferred revenue, but it's still quite similar in that the revenue flows through the financial statements and you make some adjustments for things like recognition of earnings and revenues and expenses. So let's put a revenue module in. We're going to keep the modules really simple today. If you do insert from web and you select the revenue, just type revenue. You'll see there's a whole bunch of revenue modules in here, growth rates and prices and volumes. We're just going to put amounts in. The whole point of today's course is obviously the links and the flows, not showing off how many revenue modules we've got. So let's put that in. By default, it's going to put 3 categories in. There it is there, and you'll see the separate assumptions and outputs now comes into play and this is how I always did it in banking. Although with FP&A models, we don't do it this way as much anymore because we like to see stuff changing on screen. If you click that hyperlink, that arrow, just to move between them, this is like in the automation fundamentals training course and the customizing and creating modules training courses. We had this structure. You can see you've got that compartmentalized 2 components: assumptions component, outputs component, and we just have assumptions. So let's put the revenue assumptions in. Just copy them out of the assumptions file, the headings and the categories. There's going to be a bit of copy and pasting today.
Just a little bit.
So we're going to go to the forecast sheet and we're just going to grab that data and paste the values in and then paste the headings in. I think we've made it that you can just copy and paste headings here, haven't we?
Yep.
Yeah, we put some code in to make it able to, so you can paste into merge cells because it drove us mad.
Yep.
So you can just copy and paste into modules like that, which is great. Okay, so now let's look at this. Financial statement impacts. So I'm just going to show you a diagram here. We're going to use the financial statement impacts diagrams to walk through each of these. Bear with me. I'm just going to find it. Okay, so the revenues and expenses. So if you look at the financial statement impacts of a revenue module, it literally impacts the income statement and the cash flow statement. It's assumed to equal cash. And this is something a lot of people miss when they come from doing accounting, debits and credits, into financial modeling, is they sit there and they think, oh, my revenues come in, I need to debit accounts receivable, debtors, and then I need to credit my income or my revenue. But That's not how we model it. So with modeling, what we do is we assume revenue equals cash, and then we make adjustments for working capital. And that means you can massively change the way you project revenue. You can basically change revenue to growth rates and margin, or growth rates, or based on drivers, whatever else. And you don't have to worry about the fact that the working capital is off to the side. Because often working capital is done, for example, using debtor days that we're going to go through. And that's independent of the fact that revenue could be done a million different ways. So we separate those pieces, and that way revenue is just assumed to equal cash until you then think about the actual cash receipt of revenue as a second thing. So in this instance, you can see we've got in 2019, we have the 6355.9. That's going straight into the income statement and the balance sheet. So if we now go to our outputs, just verify those outputs here, the financial statements, you can see that's coming in there, and you can see that's going straight into cash. So you can see straight down there we've got cash coming in equal to that amount. What have we got? We've got no tax in it at the moment?
Nothing.
We've got no tax. So therefore, we've literally just got revenue equaling net profit after tax, which equals change in cash down the bottom. So we literally have our cash at bank accumulating and our retained profits accumulating. It's a beautifully simple world. And if you go back to the revenue, any of the revenue module components, like the revenue assumptions, and just click on the links, we can look at the revenue links and just confirm that it's linking into the income statement and the cash flow statement. Simple stuff. Okay, now operating expenditure is exactly the same, only it's a cash outflow. That's it. Okay, so let's follow that exact same process and just bang in the operating expenditure module. So let's put in operating expenditure amounts, insert from web tool again, and then we're going to do the exact same process. We're going to bring in the headings, and we're going to bring in the data.
Small copy pasting.
More copying and pasting. There's going to be a bit of copying and pasting today. We attempted to put this on macros, but then, of course, would just always be a joke.
It'd be too quick.
Yeah. So how many operating we've got 4 operating expenditure categories, guys. So just right-click and add an operating expenditure category. If you've done the automation fundamentals course, obviously you'll know this. With that. Otherwise, check that out. That's magic. Okay, so there's those four headings. Put those data in. Now, in this case, we have
556.1.4.
556.1.4. And if you look at the financial statement impacts of this one, it's exactly the same, but it's a cash outflow and an expense rather than an income source on the income statement. So it's exactly the same as reporting as the revenue link. So if you go to the financial statements, the difference is obviously it comes in below revenue, and on the income statement it comes in as part of net operating expenses, and as on the cash flow statement it comes in as part of cash payments as opposed to cash receipts. So if you open that up, there you are in there. Okay. And again, knowing that basically now your profit, your net amount of the revenues and expenses in each period is now your net profit after tax, because we have nothing else in there, which is also your change in cash each period. So we have cash accumulating, retained profits accumulating.
Perfect.
Okay, and if you just go to the operating expenditure module and just click on the module links again, and let's just verify that that's going as the income statement and the cash flow.
Cool. So showing links here, linking both OPEX into income and cash flow statement. Cool. Same as revenue module before.
That's it. And if you go to the income statement links, you can now see them both coming in. Boom. So we're slowly building this up. Okay, so now let's put in other revenue and expenses. Now, it's an interesting one as to why you'd have other revenues and expenses. The reason why you have them is because, for reporting purposes, it's obviously to show revenues and expenses that aren't part of the core operations of the business. And this doesn't include interest revenue, for example, but it includes just strange things like penalties and fines and strange other income, maybe from asset revaluations or sales that aren't core business. So for some ratios and reporting purposes, it's beneficial to have them out, have them split out. So let's bring those in. We've put in some rental income and other income from our forecasts. Just put those headings in, and the drop-down boxes that we've got rental income allocated to operating cash flows. Now, the way we've done this, it's worth having a look through the way we've done this module when you actually, you just start pumping, you just keep pumping the numbers in here, and there's going to be quite a few of them.
Yes.
So with this, it's worth looking at how we've done this. A lot of people just hard code random other into the financial statements, or just put growth rates or do whatever else. What this module enables you to do is just put the numbers in as other revenues and other expenses, and then basically specify where you want them to impact the cash flow statement. And that's just because, for cash flow statement reporting purposes, like in, operating cash flows, investing cash flows, and financing cash flows, you want to make sure that your revenues and expenses are properly reported on the cash flow statement. So they'll always balance no matter where you allocate them here, but for allocation purposes, it's best to actually think about where each one goes. And obviously with your own business, it's going to be pretty obvious what they are, whether they're financing or investing or operating. So we've put rental income down as operating, other income as cash receipts, legal fees and other expenses just operating cash flows. And if you look at how those guys are flowing through the financial statements. They're treated exactly the same as revenues and expenses, but they're in the same module. I mean, when I look at this now, because we did this module years ago, and I think maybe we should have had an other revenue module and an other expenses module. But we put them together because they're normally quite immaterial, and most people just forecast them the same way. But, you could split them out into separate modules if you wanted to.
So they're treated in the same way, but they're in a different presentation area of the cash receipts, for example.
Exactly, and on the income statement. So if you go to the income statement, your other income is part of net. If you go to net operating expenses, other income is a part of, other revenue is a part of net operating expenses.
Okay.
Not part of your total revenue. And it's funny, if you had a module that had cost of goods sold in it with gross margin, this would ensure that your margin analysis didn't actually reflect other income, which could be quite strange. I mean, if you had a big fine in a period that was with other expense, or an other income with some court case win, or some weird other source of income like a change in the value of an asset that wasn't core, it'd be quite strange if that was in your margin analysis. So it's really just a layout factor, of determining where you actually classify those revenues and expenses.
Kind of where your core business is or not.
Exactly. So there's your revenues. Now we've got our you'll see our other revenues and other expenses, our cash flow statement, exactly the same thing. So if you look at the links, so the financial statement impacts are exactly the same. Now you look at the links from that one, you can see that that's now flowing into the income statement. The income statement now brings in all of those modules, and there's the links. Okay. So if we now go to our income statement, let's just verify that we're on track with the course. We should have in 2019 791.3.
Got that here.
Done. Perfect. Okay. So that is what we call the operational part of our model. And that is obviously where you'd normally go away now and spend 3 weeks wrestling formulas to model some obscenely complex structure. But in terms of how stuff links and flows between the different parts of the model, that's it. That's what you need to know. It's not that complicated. And we're going to now layer complexity on top of that. Okay, so now that we've done the revenues and expenses, the operational, let's move to the debtors and creditors. So debtors and creditors in a financial model is just really a reflection of the fact that obviously revenue invoices aren't received always in the same period they're not paid in the same period they're sent out. So basically the way we model debtors and creditors is we model adjustments from what you see in the P&L to what you see in the cash flow. So let's assume that I invoiced $100 and I set one invoice out in 1 year and it didn't get paid. Now, if we'd set this up the way we've set this up now, we'd have 100 of revenue and 100 of cash sitting there. So we'd have to say, well, actually, didn't get any of that. So you'd actually put an adjustment through and say movement in debtors, because obviously at the end of the period there'd be 100 debtors sitting there. Increase in debtor, that is a decrease in cash. So it would actually go through. Now that's done. That's what we call an adjustment, a working capital adjustment, and that's the way working capital is modeled in a financial model. It's a balance sheet movement. It's a balance sheet item, and the movements in that are treated as adjustments to cash on the cash flow statement. They don't impact the income statement at all. So you actually go back and research companies like, the companies that have extraordinary earnings. Like there are stories about Oracle, for example, billing enormous sales and then just getting bad debts not being paid and then paying out a whole lot of bonuses to staff and nearly going broke in the early days. Like Larry Ellison almost went broke because he wasn't managing his working capital. He was just focused on booking new sales but not collecting the invoices. And so working capital is often with small businesses and even big ones a basis for either fraud or bankrupt or cash flow issues. Okay, so it's really interesting stuff. And when you don't model working capital properly, you often really underestimate the actual cash flows of the business or overestimate them. So you look at you look at the most common way of doing debtors and creditors is using what we call the days method. The days method is simply a way of estimating what proportion of your revenue or expenses weren't received in cash or paid in cash at the end of the period. So if you think about this another way, imagine you had in a year $100 worth of invoices. Right. And the way you look at it mathematically, you don't sit there going in a financial model and say there were 10 invoices and each one was $10. You sit there and say there was $100 of revenue and the $100 of revenue was received smoothly throughout the period. So if the period was 365 days, you simplistically assume that it was received, 100 divided by 365 each day. Then you say, let's assume 10% of that wasn't paid at the end of the year. Now, you could put an assumption and say 10% weren't received, but that doesn't mean lots of people. They're like 10% outstanding for the year. I don't know what's that. So what people do is they think in terms of the number of days that would represent. And that's where you have, if you have 30 days outstanding, it means if you shot out your invoices over the years linearly, the last 30 days is still outstanding. You take 30. If there were 365 days in a year, you divide it by 365. That will give you a percentage that you would then apply and put as a debtor on your balance sheet, the increase in the debtor.
Yeah, right.
Okay, so If you had 10% of total sales outstanding at the end of the year, that would represent 36.5 days, and that would be your debtor days assumption, 10% outstanding. So what that does by using a days assumption is if you then change your revenue assumption and change it to $200, your debtor also increases by 100%. So it creates a relationship between your debtors and your revenues and your creditors and your expenses that is reliable even with changing assumptions. Okay. So it makes it reliable. Okay. And you can see the debtor days calculation I'm showing on my screen right now. Debtor days is simply the closing debtors. You just rearrange the equation. So the closing debtors equals the revenue multiplied by the debtor days divided by the days in the period. So you turn that around, and your debtor days number equals your closing debtors divided by the revenue during the period multiplied by the days in the period.
Makes sense.
So we're going to work through those calcs here just to show you how they work. This is basically how debtors is done in 90% of financial models. So once you get your head around this, a lot of it's terminology, which is the whole finance sector.
Everything.
Everyone's like, debtors, what's your debtor days? And people's like, it just sounds complicated, but it's not. Okay, so let's go into the opening balance sheet and let's put in, we've got 3 debtors categories: product launches, networking events, and information sessions. So we're going to go back to our assumptions file, get our debtors, which are obviously a current asset, and we're going to copy that data in. You should total up to 431.8. And then we're going to go and copy in our headings. Cool. And you'll see right now our balance sheet doesn't balance, right? So our balance sheet doesn't balance because we haven't actually put in a debtors module, okay? So we probably should have put that in beforehand, but it's a good thing to note because that's not going anywhere at the moment. It needs to go through the debtors module. So let's put in a debtors module, debtors debtor days module. So insert debtors debtor days. This is going to grab those opening balances and then forecast them based on debtor days are being applied to revenue forecasts.
And we're going debtor days, not closing balances, correct?
No, closing balance is just a really simplistic way of doing it. It doesn't really relate the balances to revenues. So we're going to do debtor days, yeah. So put that in, and the balance sheet will rebalance after that. And if you go to you see here, it shows you the assumptions. So the issue we've got here is that if you've got 50 revenue categories, you don't necessarily want 50 debtors categories. I mean, a lot of businesses just have one debtors category, and put the average debtor days in. But if you've got, say, in this case, we've got multiple sources. So you see we've got product launches revenues, networking events revenues, and information session revenues. Each one of them we've given a debtors category to, on the presumption that they each have slightly different debtor days, just to show how this all works. So let's allocate those to the top 3 to their corresponding debtors categories. And then let's put in 30. You can probably just type these in by hand. Let's put in 30 for the first debtor days assumption for all periods. Just put in 30. 30, 20, and 15 for the 3 categories. And you can copy those across. Okay, now let's just go to the outputs. Just click on the outputs on this and look what's actually going on here. So if you look at how this works, you'll see if you go to the revenue that's allocated to debtors product launches down in row 51. If you click on that one there, you'll see, now press F2 on that.
I may as well traverse it with LUR.
Yeah, traverse that. So you'll see, it's because it's on the assumptions. Yep. Okay. So you'll see here, it's basically saying sum if, and it's grabbing those 2. Where's it getting the revenue from? Go to debtors from that sheet. Go to the last part of that, the debtors.
So it's grabbing this from, if we traverse that back, that's
so it's grabbing it from the revenues. Out. Okay, so yeah, it's basically grabbing the revenue that's being linked in that block, and it's basically doing just a sum if, looking up the drop downs and allocating it. So you'll see it's allocating, in this case, just the first category is allocated, which is that 3943.5. Mm-hmm. And if you go back out, it's allocating that to the first category. We're then saying, okay, of that, we have 30 debtors days, which means your actual closing debtors balance is 30 divided by the number of days in the period. So if you open up the time series period titles, row 4 to 9, you'll see there we have our start date and end date. And if you look at the formula in the closing balance, what the closing balance is doing is saying, count the number of days in the period, which is that start date minus the end date plus 1, mm-hmm. which in that period is 365.
Yep.
So it's literally the revenue amount of 3943.5 multiplied by the 30 days divided by the 365 days. And that gives us our outstanding balance at the end of that, okay, which is going to be slightly less than 10% because 30 days. Okay, and then off the back of that, we then back solve what is our increase or decrease in debtors, which in this case, because our opening balance was 312.0,
yep.
Our increase or decrease in debtors is 12.1. So that's the movement. So what that means is, we, of that 312, we assume that that's been received during the period, but then we assume that more than that has actually been sent out and not paid, which is actually going to be the amount that's not paid is going to be what, 324.1. right? Which is that. Yeah, the 3.4, obviously the closing balance.
Yep.
So the difference is that 12.1 is the increase, which is what we need to adjust cash by for that period. So if you add up those three adjustments, you see at the top in the summary, you have, we've actually got 12.1, negative 2.4, and 2.2. You end up with 12.0 being the increase. Now, if you go to your balance sheet, you'll see the total closing balance there is going to be 443.8, which is an increase from 431.8. Now, if you go to your balance sheet now, and look for your debtors down under your current assets, you'll see you have your debtors now coming in, and you'll see the movement in those is actually going through the cash flow statement as adjustment. So we still have the exact same net profit after tax. But if you go down to your cash flow statement now, we now have under cash receipts. If you open that up, we now have decrease in debtors. And the reason why we've used that terminology, decrease in debtors, as opposed to increase in debtors or change in debtors, is because we've made it really clear that a decrease in debtors is an increase in cash. Okay, because that means people are paying their bills. Whereas an increase in debtors means you've shot out more invoices than you've been paid in a period. So a decrease in debtors is an increase in cash. And you'll see the whole way through the financials we use increase, decrease to highlight that an increase in this leads to a decrease in cash, or a decrease in this leads to an increase in cash. So in this case, that 12.0 is a decrease in cash because our debtors went up by the 12. And that's what because our balance sheet balance has gone up by 12 and our cash has gone down by 12, the net impact on assets is 0, which is why our balance sheet still balances, because our income statement hasn't changed at all. Okay, so that is how we model debtors. Now, let's just look at the impacts of the financial statement impacts. Here you go, the financial statement impacts. We have debtors, in this case, go up to 12.1. This is just for the first category, obviously, here. The first category, and then we have decrease in debtors of 12.1. That's it. So you'll see it causes no impact on it basically is changing the constitution of your assets and saying, I have less cash than I expected and more debtors. And the reason why that's important is because cash is king, right? You got cash, you can go to Vegas, put it on black and double it. You can't put an invoice on Vegas.
Maybe if you're Green Seal.
You can't put that on black. So basically it's important to show what is cash and what's not cash, and that's your whole working capital analysis on your balance sheet. That's why you need to do this. Okay, so basically, if you now look at the financial statement impacts including revenue, you have the 3943 of revenue coming in during the year for 2019. You have that, we're assuming that as cash, but then we're adjusting for the 12.1, which means that our actual change in cash is 3931.4 instead of the 3943, and we have a debtor sitting there. So at the end of 2019, we end up having a bit less cash than we expected and a debtor instead of the entire revenue amount sitting there.
Right.
And that's basically as simple as this. So if you go to debtors now, you can look at the debtors module, click module links, and you can see that the debtor now is brings in the debtors from the opening balance sheet. That's where it gets its opening balance from. It brings in revenue from the revenue component of the model. It's purely so you can use that as a basis for calculating your closing balance. Then that creates the dynamic relationship between your revenue forecast and your debtors forecast, which is actually how the whole model relates. That's the integrated nature of these components. And then we also bring in other revenue, which we've assumed doesn't go through debtors. We've assumed other revenue is cash. Behind you can see the drop downs. And then we have the debtors closing balance going to the balance sheet. Those guys, and then we have the debtors closing balance going to the balance sheet, the movement in debtors going into the cash flow statement. And that is what we call a balance sheet and cash flow financial statement impact combination that balances in its own right, and it has to. And that's where you see, if you go to the outputs of the debtors module now, go to the outputs of the debtors module and you go down to the error check. The error check in there checks to see it balances. You'll see there's the error values check, and the one below that is the balance check, where the balance actually checks that the opening, the closing minus the opening equals the movement. Yep. And as long as that's correct, your balance sheet has to balance. And that's an example. If you go to the error checks in this model, of where the error checks will capture an error in the balance sheet balancing before it gets to the balance sheet. And that's a good best practice model. You know, back in my banking days, the balance sheet would go out and you just go, I have no idea what's caused that. You know, one error check. Does the balance sheet balance? No. Oh.
Great.
It's like sort of being told, you're going to die. Why? I don't know. You're just going to die.
When?
And you're like, when? So you stay up all night trying to fix it. Okay, so that's debtors. And so we can now flip and we can do the exact same process for creditors. Okay, so with creditors, let's put a creditors module in and just put a creditors days module in.
Mm-hmm.
Now, we're not going to go through this one as much detail because it's exactly the same concept with the reverse terminology. You just replace the word creditor with debtor, or debtor with creditor, and everything's the same. And you replace revenues with expenses. So you'll see here with creditors, I think you put an amounts, you put an amounts module in.
Oh, I have done.
So just delete that.
So we may as well replace it.
Yeah, you can replace it actually.
switch it out for
Yeah.
the correct version.
Yeah, you can. Yeah, so replace that with the credited days.
It's a good system we've got.
Well, isn't it? So now this one here, this debtors is going to look exactly the same, but you'll see what it's going to link in is the expenses. So it's going to link in operating expenditure and other expenses from the other revenue expenses module. And in this case, let's go to the opening balance sheet now and just go to our debtors. And our creditors. Go to our creditors and go to the Wall Street Promotions assumptions and go down to creditors, which is a current asset.
Current liability.
Current liability. So I'm losing. I was actually just thinking about something completely different for a minute. So let's put that in.
These three.
Yeah, put those three in. So we've got our trade creditors, employment payables, other creditors. You can see because it's a simple chart of accounts, we've put a whole lot of fairly complex stuff in our salaries and wages stuff that would normally be broken out in a complex model, but we're just keeping it simple. So we put those in. So that should give us 376. Our total current liability should be the 376.8.
Yep.
That's looking good. And then we go back to the creditors assumptions. We're going to allocate salaries and wages to employment payables, and then we're going to put service providers to trade creditors, and general and other to other creditors.
Other creditors.
And let's enter these ones. So select the whole first row, and just enter 14, and press enter. That's one of the cool things also in modules. Yeah, and now let's do 22 days for the employment payables category, and then 30 for the other one. And let's go to the outputs and make sure you have 30.7. This is exactly as the summary. Scroll down, 30.7, 300.7. So 300.7. Now with this, it's exactly the same calculation logic, but everything's backwards. So obviously, instead of revenue, it's expenses. Instead of an asset, it's a liability. Other than that, it's exactly the same. The calculation's the same for closing balance, and the linkages are largely identical, but for the fact that it goes into the liabilities. If you go to the balance sheet, it goes into the current liabilities section of the balance sheet.
Mm-hmm.
There you go. We go into the creditors closing balance and the movement in creditors. Now, if you go to your balance sheet there, you go to your actual balance sheet and go to your current liabilities.
Okay.
Go to your balance sheet. It's probably easy to just go via the table of contents, I reckon, just to show so we can get used to it. So here you can see now we've got our trade creditors in there, and if you go down to your cash flow statement under cash payments, we now have, you see it's now called increasing creditors. So an increasing creditors is a good thing because that's like some people sending you a whole lot of invoices and you're just not paying them. And you're like, I've still got the cash, baby. So in this case, we've got an increase in, so what have we got here? Well, we've actually got we've got a decrease in creditors of 76.1, which is why, if I go and have a look at for creditors on this, let's have a look. On cash creditors. Yeah, so here we go. In this case, we have operating expenditure coming through of 5036.9, and we obviously paid more in the period than we paid more in the period than we actually spent. So we actually paid more of the opening balance that was outstanding than during the period than we incurred. So we actually ended up with a higher level of cash, which means we ended up with creditors. We end up with creditors going down.
So you got a lower number of cash.
Yeah, and this is weird. So this financial statement is quite interesting because when you look at the financial statement impact on its own, it kind of makes no sense because you've got a negative liability for creditors. But when you look at your balance sheet on this, the balance sheet, the creditors is just decreased from a total of 376.8 to 300.7.
Mm-hmm.
So what the financial statement impact diagram shows is changes in the balance sheet items.
Yes.
And that's where here you've got cash at bank going down by more than we expected and the creditor going down as well, which is coming out of cash.
Yep. Okay. So on the opening balance sheet we had 378.6,
yes.
But now on the first period after the changes, it's gone down to 300.7.
Exactly, and that's because we've paid more during the period. We've paid more invoices than we've actually received. We've paid more than we've actually been received, which means we've paid basically like a whole bunch of last year's. So we've ended up spending more money than we've actually returned invoices. Okay, so it's quite confusing, but that basically is the opposite of what happened with revenue. We shot out revenue, didn't receive it all, so we actually had an increase in our debtors and a decrease in cash. In this case, we've got a further decrease in our cash because we paid more of our opening balance than we actually didn't pay of the ones that we received during the period. Okay, so let's just go back to the creditors module and click on the module links.
This one, easy.
Yep, and you see it's exactly the same, but instead of revenue, it's expenses coming in. Our opening balance sheet gives us opening balances, and then our creditors closing balance going to the current liabilities part of the balance sheet, and our movement in creditors goes into our cash payments section of the cash flow statement. Okay, And that is our creditors. Okay, so now that we've done our operational component and we've done our working capital, we're going to move on to the fixed assets part. Now, fixed assets is another one. I remember when I first studied finance, when I first started working in banking, I remember thinking, why does depreciation exist? Why do fixed assets exist, right? And I remember for tax purposes, it sort of made sense because you're like, yeah, I remember the ATO is not willing to give you a deduction on absolutely everything. But the interesting thing with fixed assets is you're coming in, you're saying, okay, I need to recognize this. And this is the old lemonade stand analogy, right? Where I remember my dad said to me, after his MBA, he said, with a lemonade stand, imagine you bought a lemonade stand, you bought a table for $1,000. It was the most amazing lemonade stand. So you bought a table for $1,000, you ran your lemonade stand for 5 years, and each year you made, say, $500 of revenue. If you actually put the lemonade stand cost through as an operating expenditure in the first year, your first year you'd make a $500 loss, and then every other year you'd be making a $500 profit. Where in actual fact, that table is over 5 years is $200 a year, and if you ignore your cost of your labour, you're making $300 profit a year. So that's called matching. It's called matching the expense to the revenue that's incurred from it. So by buying that lemonade stand for $1,000 and using it for 5 years, you allocate that cost over the 5 years that you get a benefit from it. That matching concept is why assets exist, and it's so you don't misconstrue or misstate your earnings. So the most common method of depreciation, there are obviously some of the years digits, accelerated mainly for tax, but mostly you're supposed to use the life of an asset is supposed to reflect its actual useful life. And it's normally done using a straight line depreciation method for most businesses. Obviously during periods where the government's trying to encourage people, they'll let you write off things fast. I know our government's doing that at the moment to try and get people to spend more money on capex. But ultimately, the way you model an asset is quite simple. You put the cash through the cash flow statement because it is what it is, and then you put the asset on the balance sheet at its net written down value at the end of each period. And the amount you write it down by each period, you put through the income statement as a non-cash expense. Okay, so let's go to and you'll see the depreciation here. I've got an example here of straight line depreciation of opening balance. So if you look at an opening balance of an asset, you've got say a $100 asset over 5 years. You're just depreciating it. Your cash is going to be $100 out the first year, and you're going to have $20 a year of non-cash expense going through your P&L. And your balance sheet's going to slowly reduce it from 80 down to 0 over 5 years, and that's called your net written down value. Okay, so that's an asset depreciating at 5 years, which is 20% depreciation per year straight line. And then if you look at including capital expenditure, it gets a bit more complicated. This is a waterfall capital expenditure. The way we calculate capex, we're going to do in a minute. So sorry, it's a waterfall for depreciation. The way we calculate capital depreciation in our modules is using a really fancy reverse ticker method to get around needing all these rows. But this shows you really nicely how it would work. Where with depreciation here, we've got capital expenditure coming in of 20, and then we have each period. So you see we've got 4. So we're assuming that this capital expenditure is incurred at the start of the period, and it's over 5 years as well. So you end up depreciating each bit of capex when it's due, and that's where it gets a lot harder to reconcile your closing net asset values with your capex because it's all munged from prior periods.
Yes.
But this shows here how your basically depreciation is increasing over time. We've got our closing net asset value in this example coming down, and you've got no capex. It obviously goes straight off a cliff. Normally your capex will be at least as high as your depreciation if you're growing. But that basically is how we model fixed assets depreciation. So the primary assumption, if you're doing straight line, is the term. Right. That's it.
Yep.
But you have to allocate capex to different terms. So a machinery might have a 20-year term. A furniture might have a 3 or 5 year term. A laptop might have a 2-year term, or you might write it off as OPEX, depending if you thrash them like we do.
Yes.
So what we have to do here, capital expenditure, we don't have an historical cash flow statement. It's a forecast-only model. The capex like revenue is just going to come in. So we need to put a capital expenditure module in to start with. Again, the reason why we don't embed this within, just like we don't embed revenue and expenses within debtors and creditors, we don't embed capital expenditure in fixed assets because there are lots of different ways fixed assets depreciation is calculated, whereas often you want to separate the way capex is calculated. So you could calculate capex using like an S-curve or some type of growth rate or percentage of revenue, whatever. But if your depreciation is straight line, you sort of don't want to mess that up, just like you don't want your debtors to be messed up in your working capital by how you forecast revenue. Mm-hmm. So we're going to keep them separate. So let's put capital expenditure in and capital expenditure amounts.
Is it just using the insert from web again?
Yeah, just insert from web. Insert from web, same library, and just look for capital expenditure and select the amounts module. and insert that, it's exactly the same as the revenue module and the expense and the operating expenditure module. It's just amounts. Again, we're just keeping this really simple. So there you go. And let's just go to your, I think if you go to your assumptions file, for this guy, there's just 3 categories, which is handy, so you don't need to add any new categories. Put that data in, I think we end up with 120.6 in the first period. We've got office fit-out, office furniture, and IT equipment.
All reconciling here.
All reconciling. That is what it is. You go to the outputs, it is what it is. Now note, if you click in there, just click in there and down in CapEx down the bottom. Click in there and now do module links.
Oh.
Notice it goes nowhere. So that's important. CapEx does not go in a modular workbook directly into the cash flow statement. Now, we pass it through the fixed assets module, and we do that to ensure that it always balances. Because if you put that through and then you put assets through, you'd have to put through depreciation and movement of assets, incorporating that CapEx from a different module. So what we do is we actually feed it, it passes through the fixed assets module, and that's an important thing to bear in mind. They're different modules, and unless you embed CapEx in the fixed assets module, which we don't recommend doing, this is the way it should always work. So let's put a fixed assets module in. And we're just going to put one in that does straight line. So insert from web, fixed assets module, straight line. And after you've done that...
Straight line declining balance or
no,
just straight line?
Just straight line.
Lovely.
Yeah, we're not going to get... Declining balance is mainly for tax purposes, but we have it in there for the full range. But yeah, I mean, for this purpose, it's just straight line.
Yeah, we're not going to go into...
Yeah.
Easy. So that is dropped in now.
Okay, so let's go to the opening balance sheet. And then go to your assumptions file, and let's just put in our fixed asset categories. They are obviously non-current assets. And this is the difference. The difference between a fixed asset and other non-current assets is that fixed assets are depreciated.
Right.
So they're basically depreciable assets, whereas other non-current assets could be things like investments or whatever else. Okay, so we should have 431. Sorry, what have we got here? We should have 600.6.
Correct.
Okay, and you'll notice that the balance sheet's still balancing because that's gone through. Now, if you go to the fixed assets right now, it's exactly like debtors. Instead of allocating revenues expenses to debtors and creditors, we allocate capital expenditure to fixed asset classes. Our fixed asset classes that have come in there were off our opening balance sheet, and you can see that our capital expenditure allocation is here. So we're going to allocate each one. We're just going to allocate office fit-out to office fit-out, office furniture to office furniture, IT equipment to IT equipment. In the real world scenario, you might have a whole bunch of asset categories. So, I mean, sometimes if you've got a huge number of assets by name, you might actually allocate them based on assets by term, like 3-year term, 5-year term, 10-year term.
Okay.
That's what I've done in models where you've had like a huge number of different assets, and that means you don't end up with a huge number of different CapEx categories, and that way you don't model every CapEx category separately. So it sort of depends on the quality of your data. Okay, so let's put some assumptions in. I'll just go to the assumptions and copy these in.
Easy.
You see we have 2 different depreciation rates. One for the opening assets. Opening assets down here, we have opening assets, and then we have one for depreciation.
For CapEx.
For CapEx. Now, why do you think CapEx is generally going to be high?
Because it's brand new.
Exactly. So it's funny, when you model assets like this, you're never going to get it completely right unless you model every single pencil down to its depreciation. Right?
Yeah.
So you're just not. It's always going to be munged and mixed together. But the depreciation in those opening assets includes existing depreciation. So that 2.6 years, if it's a 6-year asset, implies that you've got sort of 3.4 years of existing depreciation on average for the CapEx that's been allocated to that class. Okay, so let's just go to the outputs on this. You want to have some real fun, learn some Excel. Crack these guys open and just have a look at these formulas.
Yes.
This is the James Longdon, who's one of our team members. His claim to fame is he invented this method of doing depreciation using basically a reverse or offset against a reversed percentage depreciation profile, which effectively means you don't need a waterfall to do depreciation.
Yes.
Even if you have 100 periods in this model, you're not going to need any more rows per category. And it's lightning fast.
It's ridiculously powerful.
We're not going to go through that in detail today because we're already going to take quite a bit of time for this course.
Yes.
But the long and the short of it is that methodology in there calculates, you can actually reconcile it. It calculates the depreciation of both the opening balance and the CapEx perfectly in a small number of rows.
And that is used to replace that waterfall that we looked at in your document there.
Exactly. Yeah. Otherwise for a 20-year model, you'd need 20 rows just for the CapEx depreciation.
Yeah, it's incredibly powerful.
It's crazy. And it speeds, it's really fast as well. So if you look at how this works, this is an interesting one. With debtors and creditors, we had a movement in a balance sheet item offset by an adjustment to cash, and that always balanced. This is a 3-statement impact, this one. So if you look at fixed asset, how it impacts the financial statements, I'll give you a link here. basically what ends up having to balance is you have the capital expenditure going through the cash flow statement. You then have the fixed asset net written down value on the balance sheet, and the depreciation of that asset is put through the income statement. So I'll give you an example. This one here is actual numbers in this model right now, I think. So you see here we have capital expenditure of 18.6 for that one, and then we have the actual asset itself. The actual asset itself is being depreciated by 177.0.
Yep.
So the net overall, it's gone down by 158.4. Okay, now if you look at it another way, imagine you bought an asset in this period. At the start of this period, you bought an asset for 100, and then you depreciated it at 20. Your fixed assets on your balance sheet would be 80, and your depreciation would be 20, and your cash out would be 100. Okay, but they would balance, because in that period you would have cash at bank going down by 100, but your fixed asset would sit there at 80, and your net assets and your depreciation would have gone down by 20. So that would have gone through to earnings. So your earnings would be down. So your net asset for the period would effectively be the written down value of that asset. Okay.
Mm-hmm.
Okay. So that's basically how we model fixed assets. Now, if you look at how this flows through, if we go to the income statement, you can see the income statement here is going to bring in, if we go down below to, you'll see, now the EBITDA obviously stands for earnings before interest, tax, depreciation, amortization. So the difference between EBITDA and EBIT is the depreciation and amortization. In this model, we don't have amortization. We've just got depreciation, just fixed assets. We don't have intangibles, or we don't have them split out anyway. So that depreciation is coming through there. So you can see the 177 for that category in row 38. And then if you go down to the capital expenditure and open that up, that's an investing cash flow on the cash flow statement. So we go to the cash flow statement, and your investing cash flow is fixed assets, and there's the 18.6 that's been purchased for that office fit out category. And then if you go up to the balance sheet and you go to the fixed assets within non-current assets, you see that 297.7. That 297.7, if you go to the opening balance, on the opening balance sheet,
yep,
we've got fixed at that 456.1. That's going down by 158.4 to get to that closing balance. Okay, to that. If you go back to the balance sheet,
yes,
that number there. So if you took the opening balance sheet number, you added the capex number for 2019, subtracted the depreciation number for 2019, that's your closing balance.
Cool.
And that's what has to balance. And if you go back to the fixed assets module and you go to the error checks in there on the outputs, the error check there has a balance check that does exactly that. It actually checks that the opening balance plus the capex minus the depreciation equals the closing. And that's the key check there. Now, assets can get really ugly when you have revals and write-offs.
Okay.
So for example, it can be really, really messy, but in 90% of financial models, that's going to be more than sufficient.
Mm-hmm.
But if you do have asset sales, revaluations and write-offs, it does get quite messy, but you just need to think about how it would flow through. So an asset revaluation is quite complicated, how it goes through a revaluation reserve and maybe through the P&L, but in essence, that's what you're building on. That's your rock-solid foundation. Okay, so let's just go to the fixed asset. On that module, let's just look at the links and just confirm those links. Cool.
Wonderful.
So we have our opening balance coming off the balance sheet, non-current asset. We have the capital expenditure feeding in, being allocated to the fixed assets categories. That's then being depreciated through the income statement. They are being depreciated through the income statement. Their net written down values are appearing on the balance sheet. And the capital expenditure in each period is going through the investing section of the cash flow statement. Okay?
Wonderful.
And that's fixed assets. Okay, so we've now done our financial statements, our revenues and expenses / operational, our working capital, which is our debtors and creditors, and we've done our assets, depreciable assets, which is our fixed assets. We now need to move to the capital part of the business. For this model, we're just going to include debt and equity, so either end of the spectrum. You can obviously talk, we're probably going to have a lot more courses on this stuff going forward. There's obviously mezz debt, preference shares, subordinated notes, all sorts of stuff. At this point in time, we're going to focus on the key capital characteristics and how you model them, because to be honest, modeling capital structure is actually relatively easy once you get this stuff. So I'm just going to look at on my screen. If you look at basically, we've now built the model down to EBIT, which is basically our revenues and expenses, depreciation, amortization. And we've done our debtors and creditors, and we've done our working capital, right? So now you look at debt and equity. Now the interesting thing about all forms, and this has been quite general, but all forms of capital, is that they have what's called a return on capital and a return of capital. So a return on capital is where you put money into a company, you buy shares, and you get dividends. For debt, you lend the money, you get interest. The return of capital is you get back you pay back the bank, and they get their money back, which is what like a bond or a bank debt facility. Return of capital for shares would be basically a share buyback, where you get bought out of the company by the business, or somebody else buys your shares, and that's where you get your return of capital. But it's important to think about those two different things: the return of capital and the return of capital when you're building a financial model, because unlike fixed assets and working capital and revenue, so revenues and expenses just hit the income statement and the cash flow statement. Then you went to debtors, which hits the balance sheet and the cash flow statement as an adjustment. Then you move to fixed assets, which hits all three financials, income statement, balance sheet, and cash flow, because of the way you have the non-cash depreciation writing down the asset for the balance sheet. With debt and equity, it gets more complicated, because you actually have the return of capital component is basically money coming in and out, which goes through the investing, the financing part of the cash flow statement. But then you have the returns on capital, which is interest expense, which goes through the P&L as a cost, as an operating cost. And what's even bit more confusing is that with equity dividends aren't treated as an operating expenditure, because the financial statements are from the perspective of the equity shareholders, so they're considered effectively a payment out of the business, not an operating expense. And that's why dividends aren't reported as part of earnings. They come out of earnings. They're not reported as part of earnings. So if you look at debt, let's go to our opening balance sheet, and let's just put in our debt interest payable.
Taking that from the assumptions file. Yep.
Yeah, so if we go down, that's going to be a current liability.
Interest payable
of 20, and we just have debt interest payable as one line item, just up there, and it's just 20. It's a hard 20, I think. Probably just type it.
Could have banked it in.
Yep, and then you go down to the bank debt itself, which is a non-current liability. It's a non-current liability because most bank debt is more than a year, right?
Correct.
So bank debt, working capital facility. We've got two facilities here. I'm going to delete the last category.
Beautiful. And
850 and 55. Okay, and we delete that last category. Okay, and we have 905. So what we've actually got there is we've got two debt facilities with a total debt outstanding of 905, and we have interest payable, which is interest that was basically incurred during the last period prior to the opening balance sheet, hasn't been paid, is outstanding. Okay, so now if you look, the interesting thing about how to look at basically debt is that return of and return on capital. Now, another thing to bear in mind with financial modeling, this is where it gets complicated. Now, we go through this in detail in the next course, which is the Historical and Forecast Financial Modeling course. But where things get complicated is where you have historical financial statements, which includes the opening balance sheet, where you have multiple categories of data that aren't mapped perfectly with forecasts. So in a perfect world, that interest payable number would be broken out by bank debt and working capital facility. But it's not. There's one line item. So you don't know which facility that's allocated to. So unlike with debtors, where you only had to allocate revenue, and creditors where you only had to allocate expenses, and fixed assets where you only had to allocate capex. In this instance, you either have to allocate that or just do something really simple to get rid of the problem. So what we do in this is we with debt, and with a lot of similar cases like this, we choose one account and we call it the key account. And this is where you've got categories and you've got multiple unrelated categories. So one could be 2, one's 5. In this case, we use debt as the key account because it's pretty much what people look for on the balance sheet. What's your debt balances? And interest payable isn't that important. So what we do instead is we put in a module specifically to deal with the fact that interest payable needs to pass through the financial statement somewhere, but we're just going to deal with that separately, and then we're going to grab the closing balances for debt and use them as the basis for forecasting debt facilities, but everything else is going to be unrelated to that. Okay, so I'll show you what I mean by this. We're going to put a special module in called a debt opening data module, and what that's going to do is literally the sole purpose of it, as we've got in the notes here, is to forecast the financial statement impacts of the debt non-key account, which in this case is just the interest payable account. So let's do insert from web and put in a debt opening data in brackets interest payable module. It's very strange, but there's method behind the madness on this.
Right.
Because the problem is if we didn't do this, you'd force users to enter historical data in line with the debt facility data, which they're not going to have.
No.
I mean, someone's going to have like financial statement account. Someone's going to get data out of QuickBooks or Xero or Hyperion. They're going to have the debt facilities broken out almost certainly, but their interest payable is going to be 1 or 2 lines, or it's just going to be 1. Mm-hmm. So you just don't have that quality, right?
Okay.
So here, that's put the module in there. Now ignore that header row. Click on the outputs, and you'll see what this does. It brings in the opening balance there, a 20, it assumes the opening balance is paid in cash in the first period, and that goes through the financial statement. So if you now go to your balance sheet, the balance sheet will have the interest payable. If you open up interest payable, you'll see that you have there debt interest payable. The opening interest payable is there, and that's now linked into that new module. Those second two categories, just leave them for now, but you don't need to worry about those. They're just spares. But that number is coming through there, and you see it's gone to 0. You could actually change the calc in that module to run that off. And if it's a monthly model, pay it in 3 months out. But in this case, we're just assuming it's all paid. And the reason that will balance is you go into the cash flow statement, the interest payable is going down to 0, and that's a negative 20 cash, which is the interest paid. So if you open interest paid, we have in there opening increase in historical interest payable, which is the opening interest payable. Okay? So that means our opening interest payable, we don't need to worry about that anymore. That's just a really smart way of dealing with that problem. And now we can just focus on the debt facilities, which is our forecast debt. So to do that, we're going to insert debt modules. Now, to put in a debt module, if you look at, I'll just show you. So if we just look now, what we just went through there on my screen is the debt interest payable is being put through as interest paid in the first period, and it's a decrease in interest payable from 20 to 0. So on our opening balance, it was 20. End of 2019, it's 0. That's a decrease of 20, which is a decrease in cash. Decrease in liability, decrease in cash. We paid it away.
Cool.
Okay. So if you look at the links on that, so go back to the debt opening data module and just look at the links on this.
And we'll go to the outputs.
Let's go to the outputs and look at the links on that. You'll see it's got in it. It just brings in the opening balance interest payable. It forecasts out the debt historical interest payable, which goes into that strange part of the balance sheet under interest payable, which is compact. And then we actually have the movement in the debt historical, the movement in historical debt balance there. That goes into the cash flow statement. That's how it works.
Right.
Okay, so this is quite tricky stuff, but the reason why you need that is purely because we want to use one module per debt facility. And the reason why we do that is so going forward, if you wanted to swap in an annuity module, a credit foncier module, or something else, you could punch in modules. If you actually had them in one module, which we used to have in the old days with categories, you'd have to try and map all the data, which we don't want to do. So we've basically got rid of the related debt account that is not relevant to forecasting the balances.
Okay.
Right? So we just got rid of that. It's a simple way of treating it, but it works 99.9% of the time. Okay, so now let's put in a debt facility for the first one, for bank debt. Okay, to do that, insert from web, and just do insert debt facility. We're going to use balances amounts all in rates. And this is, so the balances amounts module, that one there, click on that. We don't have a lot of debt facilities in there right now. By the time you do this course, we may have more. We're adding them. We're going to add a lot soon. We normally customize these as templates. But this module here is quite simple. So it just has drawdowns and repayments assumptions, and then we have an all-in interest rate assumption. That's it. You can customize it really easily with Excel. So with this one, now you've got that in. Let's copy the assumptions in. You see that's linked in. That's linked in automatically the bank debt from the opening balance sheet because it's the first category. Put in those numbers, and then I think the rate's just 10% across the board, so you can just type that in. It's just 10%. Okay, so if we look now here, before we do anything here, we're actually going to put in the other debt facility. Now, this is complicated stuff in terms of modules, but it's really simple to use, and that's that. What we're doing here is we're going to use one debt facility module per debt facility. Now, to do that, we could insert another debt facility now, or we could just duplicate that one. So if you duplicate that one, don't copy assumptions, just do duplicate once and just do OK. That's going to duplicate that debt facility, which is the same as inserting it because we hadn't changed it at all. And it's going to link to the working capital facility. So now you'll see the balance sheet's balanced again.
Yes.
So we're like, bang, everything's coming in line because that's now going through the financial statements. And we just need to put some assumptions in for that. So let's put some assumptions in for the second one, which is I think we've just got a 5 repayment in 2019. Just 5 there. And the rate on that is 15% across the board. Now, if you go to the outputs on these facilities, they're quite simple. But the really cool thing about this, the way this is structured, is that the funds drawn block is the return of capital, return of capital analysis, and the interest payable block down below is the return on capital. Now, with debt, the return on capital is the interest. That's how the bank gets its return on capital. The return of capital is the repayment of the debt, so which is the drawdowns and repayments. Now, the important thing to bear in mind when you're looking at how to balance these instruments through the financial statements is that there are 2 different sets of balances that need to take place. And if you open the error checks there for the total error checks result, you'll see we have the funds drawn check, and that checks that the opening balance plus the drawdowns minus the repayments equals the closing. That has to balance in its own right. So we do a check there. The second check is the interest payable balance, which is that is an interest payable is equal to your opening balance plus your interest expense, which is reported on your income statement, like a revenue item.
Yep.
Minus your interest paid, which is what was actually paid. I should say, sorry, as like an expense item. And interest paid is like actually paying the invoice, which is where you actually have the cash payment and then the closing balance. So your opening interest payable plus your interest expense minus your interest paid has to equal your closing interest payable. And that's the second check. But you can look at how both of these impact the financial statement separately. And I can show you this. So here on my screen, I've got the debt balances impacts. And this is where modular development and modular thinking is the key to everything. Because as things get more complex, even in one module like this one, you have multiple impacts, but they still balance. Each set of impacts balances. So in this case, you look at 2019, we repay 50 of debt. That means our debt balance on the balance sheet goes down by 50, and so does our cash, and that balances. So the financial statement impacts of the debt balances, which is the return of capital component of debt, is a financing cash flows impact of cash in or out, depending on whether it's a drawdown or repayment, and that is offset by a movement in debt on the balance sheet as a non-current liability.
Yes.
Now that's that part. That's the debt balances. Then you look at the funds drawn, and the funds drawn is the interest payable is very similar to an expense with an associated creditor. But the creditor exists if you don't pay it by the end of the year. You owe the bank money from the prior period where you incurred interest but you didn't pay it. So it's almost like an expense module with a creditor module buried inside of it. And that's where that balance is just like those two. So the interest payable pieces here, you have your interest paid is 85. Your interest expense was 85, so in this case we don't have no interest payable. But if our interest expense for the period was 100, we only paid 50, we'd have 50 outstanding at the end. It would still balance, we just have an interest payable balance.
Okay.
Now when you look at the combined impacts of those, you end up having, whoa, I've got stuff going on everywhere, but in your mind you need to think about the fact that what you've got there is related drawdowns and repayments components being offset by balance sheet debt, and interest expense and interest paid being offset by interest payable liability. Okay, a current liability. And that's how debt becomes very, very simple when you think about it that way.
So separating out return on capital versus return of
capital.
Okay.
And it's funny. The interesting thing with debt is because the income statement is from the perspective of the equity holders in the business, the interest expense is considered an operating expenditure for reporting purposes on the income statement, which is why it's part of earnings. Okay. Which is why you don't see interest expense between EBIT and net profit before tax, because it's a return to the shareholders of the entity that's having its financial statements reported, which is why dividends come out of. You can see dividends declared down there as part of retained earnings. They come out of the retained profits. They come out of retained profits that flow, that are created by profits from the income statement. Okay, so that's how basically our modelling of debt works. And it doesn't matter how complex you do debt, that's basically how it works.
So fundamentals.
Fundamentals. It works for every business ever. The most complex project finance model in the world is based on the same concept. Everyone just thinks they're smart because they make stuff really messy.
You said at the start, finance jargon.
It is finance jargon. And so with this, let's now just look at the links for that. You can see that. And again, the software obviously doesn't split out your return of capital and return on capital links, but it does show you if you click on the links there, it shows you you've got your debt interest expense going through your income statement, your movement in interest payable, you've got your interest paid going to the cash flow, and your interest payable, which is the difference between those, going into your debt interest payable and your closing balance in your balance sheet. You've then got your debt closing balance going into the balance sheet, and the difference between those is the net of your drawdowns and repayments in each period. So the movement in the balances, and that is debt. Ordinary equity. So let's jump to ordinary equity. So let's put in an ordinary equity amounts dividend calculations module.
Amounts dividends calculations.
Amounts dividends calculations, and these are just so what that means is the balances are just entered as amounts assumptions, which is drawdowns, which is going to be raisings and repayments, and the dividend calculations is basically the method we're using to calculate dividends, which is instead of just hard coding dividends, we're going to base them on. You'll see here we're going to calculate them based on a percentage of NPAT. So let's put in first of all, let's go to our opening balance sheet, and in our opening balance sheet, let's just go and put in our ordinary equity balances, which obviously we have two different things here. We have ordinary equity down the bottom under equity, which is that 500. And then we also have our dividends payable. We should have. Do we have a dividend payable in this one?
We have other equity.
Don't do that yet. Don't do that yet. Leave that one. Just don't worry. Just leave it there. That's fine. Just don't put the number in, because we haven't put the other financial statement impacts in yet. Okay, so there's the 500 there, and if you go up under creditors, do we have a dividend payable? So we have a dividend payable amount in the line there, in line 44. I'm not sure whether we have anything in. Let me have a look. Yeah, we do. We've got a dividend payable
130.8.
And that's obviously, so that amount at the bottom in your equity section is your return of capital component, and your interest payable is part of your return on capital, okay, which is your dividends. So let's just go to the actual forecast now and just put in we've got a couple of buybacks projected for 2019 and 21. So let's just go down to the assumptions for ordinary equity. And okay, yeah, so with those guys, let's go to your assumption, your forecast, your assumptions file, and go to your forecast. Okay, you see we've got the 50 and the 50 there. Just copy them across as buybacks. And I think we have for all periods, we've got 50%. So we've got percentage of net profit after tax.
All years.
Yep, as our dividend. And then we've got 50%. You see this module also has in there a checkbox that says limit dividends to prevent negative cash at bank. That's on by default, which is obviously a pretty smart thing to include in there. Just ensures so if you now go and look at the calculations of this, you go to the outputs, just like debt. So what people get so confused by this stuff. The reality that they're all very similar. They've just got different hierarchies of who gets paid what and how their payments are determined. Mm-hmm. And if things go sideways, who gets their money back. But you look at ordinary equity, it's obviously the lowest ranking form of capital, but they obviously get the highest return if things go well. Now here, the drawdowns and repayments are financing cash flows for the business, just like debt. It's treated exactly the same, just with different names. So we'll go through that in a minute. And then we've got the dividends, where the dividends, instead of interest expense, which is what we have for debt, we have dividends declared. Dividends declared are non-cash. They're only cash when they're paid. So if you declare a dividend and you don't pay it by the end of the financial year, it sits there as a dividend, as a dividend payable on the balance sheet, okay, which is a liability, which is what's happened here. The actual the determination of dividends is really up to you. In our business, we'll often declare dividends depending on how big our next hot trip to Vegas is going to be, or what car I want to buy, which is quite normal in a small business. In a big business, you'll declare dividends based on percentage of profits, or how much, what your earnings per share is, what your dividends per share you want to keep your shareholders happy. So in this case, we're just saying, okay, this company is probably a small business, just paying out 50% of its profit, obviously limited to cash, which is not an issue here because we have solid cash at bank. So in this case, we have net profit after tax of what, the 438.4. We then have opening cash is not going to be an issue. Total cash available is that 50%. Our target is 219.2. That's not limited by cash at bank. So we declare a dividend of 219.2. Now, if you go to, I think in this we assume the dividend is paid after the next period because you don't know what your earnings are until the period's over. So if you now go to the outputs here's the outputs here. So if you look up above there, we start off with 130.8. We assume that's just paid in the period with dividends because you wouldn't leave a dividend outstanding for more than a year. So we assume that's paid. The dividend declared is calculated down below, and that comes through. And then the closing balance is basically, in this case, the dividend declared because it's not paid in the period. So you'll see here that if you look at the financial statements, the first two things here, I'll go and look at the financial statement impacts of this. Exactly the same way here, we're buying back 50 of equity. Mm-hmm. So that's a decrease in cash. That's a decrease in cash in the cash flow statement, which is a financing cash flow. And then we have equity decreasing on the balance sheet by 50. That's our return of capital type situation. That's being 50 or $1,000 is being returned. Now the return on capital, dividends are being declared. Now, as I said, dividends declared are not an operating expenditure of the business. Dividends declared are a shareholder return, so they don't appear in the income statement. They come out of net profit after tax. So you can see our retained profits. The opening balance of retained profits plus net profit during period minus dividends declared gives you your closing retained profits. In this case, we declare the dividend of 219.2. We pay the prior period's dividend payable of 138.8, and the change in the dividend payable is 88.4, which is basically the difference. Mm-hmm. Which is funny because that's the prior dividend payable going down by 130.8, and the new one going up by 219.2.
The full amount.
Yeah, and the net of that's the 88.4. But it doesn't impact earnings at all. It just comes. Money coming out of the business. So it's just cash coming out of the business when it's actually paid, and the equity decreasing when it's declared. And that's that. So when you look at them combined, you end up having your equity raisings and buybacks being net down 50, which decreases your equity balance. That's your return of capital. And then you have your dividends declared being your return on capital to shareholders, which is declared 219.5 but not paid. The prior declared of 130.8 was sitting there, is paid during the period. And the difference between those means your dividend payable goes up by 88.4, which in yours, if you go to your balance sheet, let's go to the balance sheet in the financial statements. We now have we now have dividend payable of, where is it? It's a current liability, so there it is, 219.2, which is the amount we declared. And that increase is 88.4 from the 138.8.
Makes sense.
Okay, cool. So that's equity. So you look at your and that there's a lot in the documentation about this because it is quite complicated. But let's just check our balance sheets right. Actually, 986.2.
Correct.
Yeah, cool. So debt and equity are quite complicated in essence because just those two components we had multiple debt facilities. We had to deal with a non-key account, which is the opening interest payable balance that we didn't know what to do with because it wasn't mapped to anything. Then we had to make sure that the balance components of the debt balances balanced through the balance sheet and the cash flow statement. Then we had to do debt interest expense versus interest paid, which with a payable rounding off through the balance sheet. Then we had to do the whole thing again for ordinary equity, but for the fact that dividends go through retained profits and come off against asset equity rather than go through the interest expense on the income statement. So it's complicated stuff, but once you get it, it's quite simple. And if you think about it in terms of those pieces within the modules, within those areas, it's really simple. But if you stop thinking about it that way, it can get you into trouble. The interesting thing with ordinary equity is it's always the lowest ranking form of capital, so it doesn't have categories. So you don't have to worry about that mapping of the interest of the dividend payable because it always relates to your ordinary equity shares. Whereas if you've got like mezzanine shares or subordinated debts or Class B shares, they're treated more like equity, like debt for reporting purposes, for modelling purposes.
Yes.
Okay. So let's move on to corporate taxation. We have a much more advanced corporate taxation class. It's further down the learning curve. Today we're just going to look at corporate taxation in its simplest form, which is still good, allowing for, say, tax losses and the payment timing of tax. So let's put in a corporate taxation module just to insert from web. We're going to do insert corporate taxation, just tax payment timing. So we're going to keep it quite simple.
Tax payment timing, lovely.
Tax payment timing. This is the only module we're having. This Chart of Accounts 1 doesn't have deferred tax assets and liabilities, so we don't have to worry about all that scary stuff, which is fun when you get it. It's scary until you don't.
Yes.
Well, you don't. Okay, so let's just go to our opening balance sheet and just put our corporate tax payable in as a 45.7, I think it is.
Yeah, where are we? Corporate tax payable.
Corporate tax payable, current liabilities. There it is in row 39, I think it is.
There we go. And what was our amount?
45.7.
0.7.
That's great, and that's it. I think that's the only balance sheet item we have to worry about. So then go to our corporate tax assumptions, and we're putting 40% in as our tax rate. We're not going to put any tax losses in. Now, if you want to learn how corporate tax works, we have a corporate taxation training course that's intense, that's extremely good. This took me 6 months to learn corporate tax when I was in banking, and it's one of those things that I think most people still don't know very well. The complexity with tax is obviously that when you have a tax loss, the government doesn't give you money back. You build up tax losses and offset them against future profits, and that creates what's called deferred tax assets. And you have accelerated depreciation. There's a lot of things going on here. For all intents and purposes, most models, particularly an FP&A model or a budgeting and planning model, you can do tax quite simplistically. And what we do here is this module just takes in net profit before tax from the income statement. It assumes basically that your income statement reporting of items is the same as your taxation reporting, which is not overly realistic, but not particularly not accurate either in most cases, particularly for mid-sized businesses. So you end up basically, if you go to your calculations, let me just check whatever the assumptions. We're going to put 75% down the bottom as tax paid period. So the reason why we put 75% in this example is a lot of companies pay tax quarterly, which means if you're doing quarterly BAS and everything's nice and clean, you've got a profit, you're generally going to have about 25% of your tax liabilities outstanding at any point in time because you'll get assessed at the end of December, and that assessment at the end of December will actually flow through and won't be paid till the following March, maybe even longer. But this is just simplistically saying, let's assume a quarter of your tax isn't paid during the period.
Okay, all makes sense. So now, should we go over to the output section?
Let's do the outputs. And you'll see it's quite simple, this module. We've got the tax expense, which is literally, we've got the tax expense. So that's the output at the top, actually. Yep. So you've got net profit before tax coming in. We don't have any adjustments, which you could put in permanent differences, all sorts of stuff. The tax training course covers those. Then you have the taxes. You have our profit before tax utilization. We don't have any tax losses. If we did, down below, it would carry them forward. Mm-hmm. If you want to have some fun after this course, put some tax losses in and watch how they flow through. It's really cool. It's like a waterfall effect of consuming them before you ever pay tax. Now, then when you actually do apply your tax rate, you get a tax payable for this period of 174.5. Now, we've assumed in this instance, if you go down to tax paid during period, we've just simplistically assumed that tax payable equals tax paid, but we've obviously put through that 75% as an adjustment as well. So so we've assumed that you look at that rate, if you traverse that formula, that is literally just saying, okay, go back to the 75% assumption, I presume, on there, and it's saying, okay, put whatever is paid during the period, put that as a paid, and whatever isn't, carry it forward for the next period.
Awesome.
So in this case, 75% of that 175.4 is paid, and the remaining balance is outstanding. And that paid during period also includes the opening balance. So the opening balance of what is that? 45.7. So that outstanding balance should be 25% of 175.4. Okay. And so this is another one where, when you're modelling tax this way and you don't have deferred tax assets and liabilities, which to be honest make things quite complicated, the tax expense is treated a lot like just a normal operating expenditure, in that you have your tax expense goes through your income statement, whatever, and then basically that your tax expense equals your tax payable when you're modelling it this way. Whatever isn't paid is effectively a creditor, but instead of being munged in with trade creditors, it's a standalone tax payable creditor, corporate tax payable, and that's that 43.8. So if you look at the error check there under there, you have to verify here for the balance sheet to balance that your opening interest tax payable plus your tax payable created during period, which in this case is your tax expense, minus your tax paid equals your closing tax payable balance.
Yep.
And if you look at how they flow through, so if you, I'll just go through and look at this on the financial statement impacts. It's very, very similar to it's very similar actually to an asset in a way, in the way you do depreciation. But so the tax expense isn't necessarily cash. So if you look here in this period, we have 175.4 of tax expense. We pay 75% of that plus the opening balance of whatever you've got there. What have you got there on that opening balance?
45.7.
So 45.7 plus 75% of the 175.4 we pay, and that's the 177.2. The remaining 25% of that is outstanding. But because the corporate tax payable balance was already 45.7, 25% of this 175.4 equals 43.8. So the actual movement in corporate taxes is a decrease in 1.9 in this period, because you've gone from 45.7 to 43.8.
So again, it's that movement rather than the balance itself.
And that's what these financial statement impacts diagrams show you, is the movement in the balance sheet item and the items, and how that's offset by cash flow statement and income statement impacts. And that's exactly what's explained in the learning materials here. So if you go to just click on the module links on this one.
There we go.
You see here, opening balance, corporate tax payable, current liability coming from the opening balance sheet. Our income statement brings in net profit before tax, which is used as, I might have said after tax before, but I meant before tax, which is used as the basis for calculating your tax payable.
Yes.
Which is then, but then 75% of that is used to determine your tax paid in this case. And the difference is obviously the closing tax payable on your balance sheet. And that is basically how 95% of financial models calculate tax, but corporate tax, because deferred tax assets and liabilities are really complex, and they are valuable if you know how to model them. A lot of people, for a basic planning or budgeting model, you probably don't need that level of detail, so this is perfect.
Yes.
Allowing for tax losses is probably the key. You do need to allow for that. And if you've got a really asset-rich business, you probably need book and tax assets. But this is the core concept. If you want to learn more about corporate tax modeling, we do have a whole other course on that. Okay, so let's just verify. Go to our income statement and just verify that we have 263.0 for 2019 as our net profit after tax.
263.0.
And at the end we should have 313.3. Perfect. Okay, so this model is largely done. And I remember when we first trained Goldman Sachs on this, we had software back in the years that didn't do other current liabilities, other assets and liabilities. Yep. So we were like, yeah, that's it. And like, well, what about other things like provisions and stuff? Like, just they're not big numbers, but people look at them and go, the financial statements don't reconcile with what we're used to seeing in the annual reports. And we're like, oh, we need to add these. So what we've got in this module, there's two other things we allow for. One is interest on cash, and the other is other balance sheet items. We obviously did other revenues and expenses as part of operational. Let's put an interest on cash module in first. Interest on cash module is just a module that literally calculates your interest on cash and potentially your deposit payment on your interest if you've got an overdraft, just so that you earn, so it reflects that. Now, back when I started in banking, you get a good rate on your interest on cash. You get like 5 or 6%. At the moment, I know you get 0 or 0.1, but the overdraft rate's still horrible. so you see here we've got our opening cash at bank, our base interest rate. Let's just go and grab that. Go and grab those rates out of I can tell them to you actually.
Yep. Base
interest rate's 1% in all periods. The deposit's margin is 1%, and the overdraft margin is 2%. This was obviously created in better times. but yeah, so it's nice. 1%. So you see here, if you go to the outputs here, the way we've done this interest on cash calc is literally just using the opening balance. Now what that means, we used to do it based on like a really complex proxy of average balance, because that would be more accurate. But you obviously get in trouble with circulars, because your closing balance is impacted by because interest on cash itself is assessable for tax purposes.
Yes.
But then if you look at your closing cash, that's after tax, which is based on interest on cash, so you're circular. So in most cases, if you don't have cash massively increasing, you can just do opening balance like this. In any case, it should be conservative if the cash is going up.
Yep.
So in this case, we have the 1217.2. Our base rate's 1. Our deposit margin's 1, so we have 2% on that. So it's just 2% of that. And that is treated just like revenue. So if you look at the financial statement impacts of that, it's treated just, so look at this here in the course. Interest on cash is just treated like revenue. It's assumed to equal cash. We don't even include it in debtors. It's just cash.
Yep.
So it's on the income statement. It comes through under EBIT, so it's not part of EBITDA. It's part of net interest expense. So it comes through on the income statement, and it comes through as an operating cash flow. That's another one. It's an operating cash flow, not a financing cash flow. Okay, because it's money earned on the cash as a result of the operations of the business. Okay, and if you go to the module links on that, you can see that the opening balance sheet has the opening cash balance comes in to the interest on cash for that, because that's what we need, the opening cash balance from the balance sheet. And then we apply the rates to it, and that gives us the interest on cash, which flows into income statement and cash flow, just like revenue.
Yep, just directly in.
So you can just go to the income statement now and just check that out, make sure it's there. You can see under net interest expense, there it is, interest on cash at the top.
Wonderful.
Before we deduct our interest, and down below under the cash flow statement, we have interest on cash as row 197. It's just its own row. That's
awesome.
It. Cool. And that's it. So that's interest on cash. Now the final thing we need to do, if you go to our balance sheet, you'll see that there's a whole lot of other items. If you go to the assumptions file,
yes,
you look at our balance sheet, there's just a whole lot of other fluff. But people are not going to be happy if you don't give them everything. The balance sheet doesn't reconcile.
Yeah, of course.
So we need to include that. So let's include what we've created a module called an other balance sheet items module. Let's include one of those other balance sheet items movements module. And what this module is a very simple module that enables you to actually make assumptions about movements going forward in other balance sheet items. So by default, if you enter nothing, it just assumes they stay what they were on the opening balance sheet. But it's kind of handy, because if you think if something's going to just randomly disappear in 3 or 4 years, you can come in and say, okay, let's just put that in, let's make its movement equal to negative what the balance was at the start of the period, at the end of the prior period, and we'll wipe
get rid
it
of
off.
it. Yep.
So in this case, if you go to your go to your opening balance sheet, and this is where you need to go on a crazy copying and pasting rampage. So start off with your other current assets. We have prepayments and other. Prepayments and other for other current assets. You're going to have to scroll up. Prepayments and other. And they're going to be 8 and 7 for those guys. It's annoying you can't copy and paste them all together, isn't it?
Yeah. One step away.
Such is life. And you see, Ewan's just deleting categories for this as well. So for other non-current assets, we have rental bond, director's loans, and other. So 240, 105, which gives you a total of 345. And after you do that, that should give us a total assets balance of 2609.5. Nice, you're in good shape.
2609.6.
So 0.6, sorry.
There we go.
My eyes, I'm getting older. And the other current liabilities, which is credit cards and other.
Credit cards and other. Yes.
31.5 and 12.4.
There we go. They are dropped in, and I'll just delete that final category as well.
31.5 and 12.4.
Might not have got that 12.4. There we go. 12.4 in.
Yep.
Now non-current.
So, non-current, we have provisions, leases, and other. And that is 42.5, 24.0, and 3.0.
3.0.
And after doing that, our net asset should be, drum roll, 1017.9.
Happy days. Got it.
When this other equity of 20, which you tried to sneak in before.
It's jumping ahead of the gun.
And you'll see the balance sheet's not disbalancing because we have, now everything balances. Balance sheet's not disbalancing because we put that module in.
Yes.
So if you now go to the forecasts, we just need to, I can list these down for you. So for prepayments, let's go operating cash flows. For other, the operating cash flows for the first two. Then for other non-current assets, let's do operating, and investing.
Sorry. So we're other revenue. What did you say for the first two?
So this one, other cash. This one, do other
revenue,
operating cash flows. Oh no, sorry, where are we here? Other balance sheet items.
So other current assets, we've got an income statement and a cash flow statement. So we've got operating cash flows, correct? For
I think you put the wrong module in again.
Have I?
Yes. I think you've put in there. That's an interesting context. What you've put in there, what you've actually put in there is an other balance sheet items module with interest rates, which you can
Didn't
use.
know we had that.
Yeah, which you can use to actually. Yeah, I think the one you put in, if you have a look at it, you put in interest, right? So just put in movements. Just replace it with that one for movements.
That's a good one to know.
That is good. That's right. Just ignore that. That's an interesting module. So okay, so we put this in. It should still link fine. And we're going to. So for this, we're going to do prepayments and other. We're going to put in operating and operating. Let's see if that's okay. Cool. You're still awesome. You're all good. Okay, so just put in operating cash flows. And then rental bond, direct loans and other are operating, investing.
Operating,
and investing.
Cool.
Yep. And then the other current liabilities are credit cards, cash payments. And other is operating cash flows.
Operating cash flows.
Yep. And then the other non-current liabilities is provisions as operating, leases as operating, and other is financing.
Done.
Yep. And then the other equity is financing, which is fine.
Perfect.
And we just need to copy in the forecast changes. So for the other non-current assets, we've got a change of 50. We've got a change of 50 in that first period.
And that was for director loans, I believe.
That's director loans, yep. And then we have credit cards and other. There's a whole bunch of stuff in there.
Just copy and paste those ones in.
Yep. Same with other non-current liabilities.
And then just -5 in the first period for other equity.
That's it.
Awesome.
And so if we look at this one, so this is an interesting module. It's effectively a gap fill module. So if I look at on my screen, if we look at income statement, balance sheet, and cash flow, we don't impact the income statement. So all we're doing here is we're just putting the movements through parts of the cash flow, and that allocation you were doing is designed specifically to enable you to control where they hit the cash flow statement.
Right.
So the cash flow statement, really, we divide up into 5 areas in those. If you hit one of those drop downs, we divide it up into cash receipts, cash payments, operating cash flows, which is basically other than the other, obviously the first 3 are all operating cash flows, but that's other operating cash flows. And then you've got investing cash flows and financing. So you can see if you go to the balance sheet, you can see that all those items are now in there on the balance sheet under other. So other current assets, you can see them all in there. And then if you go down to the cash flow statement, you can see the cash flow statement in each of the 5 sections. So under cash receipts has a section at the bottom which is other cash receipts.
Yes.
And you see those guys, the other revenue cash receipts are coming from the other revenue and expenses module.
Yep.
But the other balance sheet items is that one item at the bottom. And if you double click on that, you can see what happens in this module is it just groups up and allocates using effectively sum ifs down below, which basically you allocate them. So it basically enables you to allocate where you want them to be on the financial statement. So it's a bit of a plug module. The data in your other balance sheet items shouldn't be hugely significant. If it's a significant part of your balance sheet, you probably should build a custom module for it or have it in something like fixed assets or somewhere else. But in most cases, these should be relatively immaterial numbers.
Okay.
And you're just doing it so the financial statements reconcile. Okay, so let's just look at the other balance sheet items links. But again, just the important thing to note there is that we're just balancing the balance sheet movements in each of those items with a corresponding adjustment to cash.
Yes.
But they have no impact on earnings. That's it. That's the key.
Mhm.
And you look at the links on that. We have opening balance sheet bringing in all the opening balances of all those other other balance sheet items, and then we have the balance sheet items being forecast into the balance sheet and the movements in those being allocated into those 5 areas of the cash flow statement. So it's a little bit confusing because that you can't track the other cash flow, the other cash receipts adjustment to a specific item because they're all bunched together.
Right.
But to do it another way would have potentially a huge number of categories in the cash flow statement just for these tiny items, which shouldn't be that major. So that reconciles. Let's just check we've got it right. So NPAT should be 277.7.
Drum roll.
Drum roll.
Where are we?
277.7. That's great. And net assets is 1101.7.
Got it.
Done it. Okay, so the final thing, let's put a dashboard in, just because they're so cool.
Fun stuff.
So the dashboard, we're just going to put in a presentation output dashboard, a financial statement summary dashboard. So let's put one of these in.
I'll get the right module this time.
There we go, financial statement summary dashboard. Let's put that in. And the beautiful thing about the dashboards in this, obviously they're an absolute pain to create, but it's also that they just print perfectly and they're ready to go.
Yep.
And obviously you normally customize your theme to get away from the default Excel colors we're using here, and put your corporate themes in or put some cool Hero Investment Banking theme in. With some matte colors, but I mean this is just using the default theme, and so that'll go in. And if you preview that, so let me just check that reconciles. We have 277.7, yes, and let's look at net assets down below, 1101.7, and if you just preview that,
right, print preview,
boom. So and that's it. So the process we've gone through here now, just to recap. you'd never build from scratch like that.
Never.
So if you cancel that preview and you just go to new and do dynamic template, the template we would have chose for this, if you just do summary view, just go to generic financial model. Generic financial model, we would have chosen that generic financial model there. Open that one, and if you just do annual United States single separate assumption outputs, open that one, you'll see that is actually the model we've just built without
Correct.
data in it. So the process, and that means you can obviously bring in your. So what we would have done here is that's the model we just built. If you compare that to the income statement of ours, the one we just built. So go back to ours. Go back to ours with our numbers in it and go to our income statement. It's exactly the same model.
Mm-hmm.
Okay, now if you go to the other one, and then you go to the opening balance sheet, and now click on column J and just do import assumptions. Import assumptions and maybe specify the opening balance sheet from the other module. So Excel, and just specify maybe the
Wall Street promotions.
Wall Street promotions, yep. And just change the sheet. Was that forecast? Change that to the opening balance sheet. Just like that whole sheet.
We want to use a generic financial model.
Yeah, you could do that, or you can get it from there. You can do the generic financial models. Just do next, and then just leave that and just click next for the time being, and you can see there's the data. Oh, you've got to change your rows. Change your rows back.
There we go.
Change your rows back to go back and change your rows. Just change it to the entire opening balance sheet.
So highlight the whole thing.
Yeah, just do that and see if it gives it to you. Yep. And it brings in all that data, right? I think you might have just tried to link in your own module, your own thing. But that doesn't matter. That's how you get the data in. That's how you get the data in. You wouldn't actually enter it all manually. And then it would always balance because all the modules are already in there.
Mm-hmm.
Okay, so
this is how we would map it in.
Exactly. So cancel. I think you've tried to link in from yourself.
Yeah.
But that's where you'd start. So the normal process wouldn't be to insert modules from scratch like we were doing. That was just to explain how it all works.
Mm-hmm.
The normal process would be start with a dynamic template, import your data using the import assumptions tool, put in your forecasts, and now you start customizing. So normally what we've done today would take the first 10 minutes. And now you'd be replacing modules, then customizing drivers, adding valuations, scenario analysis, maybe multi-business units. You build it up from here. But the fundamentals are all the same. So the fundamentals we've put in place here, you need to understand those before you start jumping onto multi-business units, project finance, M&A, LBO. If you don't understand these, it's kind of like building a house on rickety foundations. So that's it. That's the annual forecast model training course. Hope you guys have hung in there. It's probably one of the most fundamental theory-rich courses we've got.
Probably.
But if you can get your head around this and forge ahead, strongly recommend going through this in detail a couple of times until you get it, and doing the practical assessment and the theoretical assessment. These are probably the most in-depth training courses we have on our website at this point in time, but the most important. So hang in there. Give us a buzz if you've got any questions, and Godspeed.